Good afternoon to everybody. This is a very important subject, Union Budget 2024-25. So it is the first budget of the third consecutive government of Narendra Modi ji. So there was a lot of expectation, and we know always budget has a very important impact on our industry. So they have to understand not only the tax part, also what is the implication of the overall macroeconomic impact. So I am really privileged. We have got very good speakers. I'm honored to welcome Mr. Kaushik Mukherjee. I had the privilege to work with him. He was my chairman of CII Economic Affairs and Finance and Taxation Subcommittee. So thank you so much, sir, for agreeing to be a speaker. Very delighted to welcome my friend from St. Xavier's, Dr. Rudra Sen Sharma. He is a very established academician in the world from IIM Kozhikode. I hope this will be a very important and impactful session for all our members. With this, I'll request Mr. S. Muthu Kumar, our Honorary Secretary of the Institute of Indian Foundry Men, and who is the Managing Partner of Bharat Chemicals, to deliver the welcome address. Thank you.
Yeah, thank you, ma'am. I'm Muthu Kumar here. Sorry, my screen is not working. I'm in a remote place. I'm in IIT Palakkad. We went for one technical session, so I held up there. So anyway, I will give my welcome address. So good afternoon for the members of the Institute of Indian Foundrymen and distinguished speakers. I'm delighted to welcome you all for today's session on Union Budget 24-25 and analysis. We are gathered here virtually on this Zoom platform to devise into an important topic that impacts not only our industry but the entire economy of our nation. As we know, the Union Budget is a crucial instrument through which the government outlines its political priority and vision for the coming years. It serves as a guiding framework of our sector, influencing everything from investment decision to the operational strategy. Today, we will decide the budget and discuss the budget implication in comprehensive manner, providing insight that are virtual for our growth and development. We are privileged to have our distinguished panel of speakers who will share their expertise and perspectives. Each of them brings a wealth of knowledge from their respective field, encompassing the microeconomic insights, industry-specific analysis, and tax implications. Our discussion today will cover a wide range of topics, including the microeconomics overview, the foundry perspectives, and both direct and indirect tax implications. So I could like to extend my heartfelt thanks to all our speakers for taking their time to share their insight with us, as well as to our participants for your presence and engagement. Your participation is what makes the decision valuable and impactful. As we move forward, I encourage everyone to actively participate in the question and answer session at the end of the presentation. Your questions and thoughts will doubtfully enrich our dialogues and help us better understanding of the budget. Once again, I welcome to this important decision. Let us embark this journey of analysis and insight together. Thank you.
Now we will have our speaker, Dr. Rudra Sen Sharma, Professor of IIM Kozhikode. He is an applied economist with interest across areas like banking, macroeconomics, financial markets, and development policy. He is the member of the Expert Committee for Technology and Innovation for Monitoring and Evaluation Lab, Niti Aayog. He is also the fellow of the Higher Education Academy, UK, External Associate, Center for Crime, Justice and Policing, University of Birmingham, Corporate or Public Sector Leadership, Research Officer of RBI he was, and he was also the Dean of Research, IIM Kozhikode. As for academic position, he is the professor of IIM Kozhikode. He was earlier senior lecturer in University of Hertfordshire and assistant professor in IIM Lucknow. He was also in Maxwell Fry Research Fellow in University of Birmingham. So he will give us the macroeconomic overview and industry implication. Over to you, Mithra. Moshe sharing right now.
Yeah, thank you very much, Abhishekta. Thank you. Really happy to interact with members of Institute of Indian Foundrymen and other colleagues. So it's a real pleasure to share my thoughts on the union budget. Now, of course, the advantage of being the second speaker is that whatever important needed to be said has already been said. So that makes my job easier. So Kaushik Mukherjee has already explained to you the main highlights of the budget. So what I'll do is I'll not repeat those, but I'll try to reinterpret them as per my understanding. So let me do it in two steps. First, let me talk about the macroeconomic situation that the country is in and the major macroeconomic challenges that we face as a country. Because after all, the budget has to be seen in that context. So the budget is better understood if we understand the challenges that the country is facing. Then I will come to the budget proposals, which I will organize under 4 categories for a particular reason that will become clear as I go along. Right, so I am assuming you are able to see my slides on your screens. So I am flagging 2 macroeconomic challenges to you. The first is the so-called K-shaped growth that the economy is going through. So what is the K-shaped growth? So this is growth where there is a divergence between high income earners and low income earners. How do we know that there is a divergence happening? One quick measure could be if you look at the GDP growth rate, as Kaushik explained to you, it is very good. Indian economy is experiencing very high rates of growth. So in FY24, GDP growth rate was 8.2%, which makes us the fastest large economy in the world. However, if you deep dive into the drivers of growth, there is a disappointing number that consumption growth is only 4%, which means the economy is growing, but the purchasing power is not keeping up with the growth in the headline GDP number. So that is the K-shaped growth that we should be concerned about. And the reason very quickly is that the job creation that has been happening has not been happening in the desirable areas where we say good quality jobs are created, like salaried work or regular wages. Rather, the job creation has happened in categories such as self-employment and casual labor. So if you look at the income data that I have plotted on the right of the screen, so this is from Government of India's own periodic labor force survey, you can see that A, the wage is flat, wages are not, or income is not rising. And B, within that, the high income category, that is salaried employee, that category has not seen growth. Whereas the job growth is happening in self-employment and casual labor, which is not a good sign. You want purchasing power to increase, and that can only happen if salaried employees experience growth. So that is the first concern that the budget had to tackle, that how to create job growth so that we can have consumption growth, which will turn into more sustainable GDP growth. That's number one. Number two is the economy has to be very careful about the debt situation. So debt, which is the outstanding loans collected by the government over the years, as a percentage of GDP had shot up during 2020 and 21. Because of the COVID pandemic, the government had to spend a lot of money, and our debt GDP ratio, which was already high before COVID, shot up further to almost 90% of GDP. Since then, the debt to GDP ratio has somewhat come down, but it is still at quite high levels of 85 or 86%. So this needs to come down, because if debt is high, it means that the government has to pay interest on this debt. and a lot of money is being eaten up by interest payments. So currently 20% of the total expenditure of the government goes into interest payment, which means less money is available for spending in other priority areas. So therefore, it is important to bring down the debt, which can only be done by bringing down the fiscal deficit. So lower fiscal deficit would mean that the government will borrow less, and therefore the outstanding liabilities or public debt can come down. So these are the two main challenges, according to me, that the budget had to tackle. And now let us see what is there in the budget to provide a fiscal roadmap to not only tackle these two immediate challenges which face the economy, but also to have a long run objective of achieving Viksit Bharat status by 2047, which means reaching a developed country economy status. How do we do that? So currently our per capita GDP is $2,500. So to become Viksit Bharat, this $2,500 has to go up to $14,000 GDP per capita. That is when we can enter the high income classification of the World Bank. So how do we go from $2,500 to $14,000 GDP per capita? So how does India become a developed country? Now, we know this from economic theory that there are 4 steps in which a poor country can become rich. So there are 4 initiatives or 4 ingredients through which a low-income country can become a high-income country. So this is established by theory, this is established by research. So let me now categorize the budget proposals under these 4 pillars of growth and prosperity. So what are these 4 pillars? They are: number 1, physical capital; number 2, labor force; number 3, human capital; and number 4, natural resources and technology. So I'll talk about each of these 4 very quickly and make references to the MSME sector to see wherever there are relevant proposals for MSME sector. So let me talk about the 4 pillars of growth. So first of all, we know that physical capitals, that is the stock of tools, machines, infrastructure in an economy, is essential for prosperity of the economy. So this was a pain point in India earlier. The government was not spending enough on asset creation, but now in the last few years, we have been seeing there have been considerable focus on asset creation. And this budget has taken that up to 3.4% of GDP, which is promised to be spent on capital expenditure or asset creation. This is a 20-year high figure. So this is the highest in 20 years. 3.4% of GDP will be spent on roads, highways, ports, housing, etc. So this is, of course, the government of India's own spending. Other than this, the government has promised to provide long-term interest-free loans to state governments so that state governments can also create assets by spending on capital expenditure. So for this, a provision of 1.5 lakh crores has been made to give these long-term interest-free loans to state governments. So this, of course, is not new. We know that this government has been prioritizing infrastructure over the last many years. Now, has it helped? There are some trends which show that this spending is finally generating results. So if you look at private investments in the country, which is measured by the government as gross fixed capital formation, so that grew by 9% in FY24. So this 9% growth is coming after a long time when we have been waiting that when will private investments pick up, but finally private investments are growing. Now private investments have grown, but that has not translated into enough jobs. And that is the second important ingredient of long run growth, that not only do we need more infrastructure, but we also need to have more workers in the labor force. So how does this budget create or labor or solve the problem of job creation? So there are 3 employment linked incentive schemes, which I'm sure you have already heard about. So to summarize, the government has promised to pay 1 month's salary or 1 month's EPFO contribution for any new employee that is hired in any sector. And there are some specific incentives for manufacturing sector for hiring a new worker. So this is intended to reduce hiring cost so that more workers can be hired and will create many new jobs. Now, one of the challenges of our labor force is that the women participation in labor force is very low. Overall labor force participation is low. About 50% of the working age population is in the labor force, which is low by global standards, but particularly women participation is lower than even Asian average. So the government has proposed a number of schemes to improve women participation in labor force, such as to set up working women hostels, to set up new creches, to specifically support skilling programs for women, and to support women-led enterprises. So this should hopefully improve women participation in the labor force. Now, coming to MSME sector, I have classified this under labor force because this is the biggest job generator and employment multiplier in the country. As you all know, 62% of jobs are created by the MSME sector. So if MSME sector grows, then job creation is going to happen. So as Kaushik said, there is a lot of focus on MSME sector. I'll not go into all the points which have already been covered by Kaushik, but specifically let me comment on one or two out of these. So this new credit assessment model for MSME firms is a very interesting proposal. So typically, loans that are given to businesses are based on the balance sheet, which is like asset size or turnover. Now, MSME sector has the disadvantage that the cycles that MSMEs go through are often linked to the kind of sector they are in. For instance, if there's a consumer-facing company, then it will require more credit during festival season. If it is a construction company, it will require more credit during the summer or the winter when construction work is happening. So cash flows, go up and down in cycles within the year. But the credit assessment does not care about that. Credit assessment tools used by banks do not make any special consideration for the cycles that MSMEs go through. But in this budget, a new credit assessment model has been proposed under which the banks will use digital footprints created by MSMEs to give them loans, regardless of whatever is there on the balance sheet. Even firms which do not have formal accounting systems can get loans if the bank is able to create a credit score based on the digital footprints. And there's a lot of work happening in the fintech industry around this, where suppose you have some website or you are selling goods on e-commerce platforms and there are customer ratings on your product. So the customer rating can be used to develop a credit score. Or let us say you are receiving payments or making payments. So those financial transactions can be used to develop a credit score. So variety of such off-balance sheet information can be picked up by the use of financial technology to build credit scores, and loans can be given to MSMEs based on that. So this is something the budget has proposed, that even public sector banks will now develop such credit assessment models, which will improve the credit flow to the MSME sector. Other than that, there is a credit guarantee scheme that has been proposed. Mudra loan limit has been doubled. New SIDBI branches have been promised. New industrial parks have been promised, about 100 new industrial parks all over the country. New e-commerce export hubs, and of course, custom duty hubs, which the custom duty cuts, which the tax experts will tell you in details later on. So the MSME sector, in my categorization of the budget, comes under the labor or job creation category, where there's a lot of thrust so that we can overcome the challenge of lack of enough jobs in the country. Now, there are two more pillars which I'll quickly talk about. So the third important pillar of prosperity or to reach Viksit Bharat is to build better human capital. Human capital refers to the education, talent, or skill level of the workers. So it's not enough just to have more workers. The workers need to be educated, they need to be talented, they need to be skilled at their work, they need to be more efficient and productive. So to do that, we need to focus on education and skilling. So the higher education budget has been increased by 8% with special focus on digital education, technical education, artificial intelligence, and innovation. School education has also received some focus with special schemes for teacher training and PM Shri schools, which is a special category of schools. So some 14,500 PM Shri schools will be opened, which will create new benchmarks for school education. For skilling, about 1,000 ITIs will be upgraded, and the internship scheme, which as Kaushik said is really for large corporates, but that should improve the skilling ecosystem and the level of skilling in the country. So this will improve the efficiency and the capability of the workforce in the country. The fourth and last pillar of long run prosperity of the country is natural resource and technology. So there is a proposal which was there in the February interim budget also. So the same thing has been repeated, that about 1 crore rooftop solar plants are being built, pumped storage for electricity, new investments in nuclear reactors and advanced thermal plants have been promised. Digital public infrastructure, which is a success story of the Indian economy in the last few years, has got special attention. So the budget has mentioned digital public infrastructure for MSMEs along with other sectors, although details are not provided, and digital public infrastructure will be used for agriculture. Finally, which should be good news for MSME sector, is that the buyer threshold for onboarding on the TReDS platform has been reduced from 500 crore to 250 crore, as a result of which the finance minister said that there will be 22 more CPSUs who will be able to join the TReDS platform, and it will benefit more than 7,000 companies to receive payments. So these are the 4 ways in which the budget is targeting to take India from a $2,500 GDP per capita economy to a high income country. Of course, this requires sustained efforts. One budget cannot do that. So we need to keep working at this goal till we become a high income country. Now, finally, before I conclude, let me talk about one hit and one miss. So what has been one positive for me and one negative for me from the budget? So the positive has been fiscal consolidation. I started by saying that the debt level has reached very high proportion, so we need to reduce debt. So the government has done an excellent job of reducing the fiscal deficit. In fact, in the interim budget, they had set a target of 5.1% of GDP for FY25, but in this budget, they have even improved it to 4.9% of GDP. And the finance minister said that this will come down even more. So she has promised to bring fiscal deficit below 4% of GDP by FY27, which means each year the government is borrowing less and less money, and therefore the debt will come down, which will help interest payments to come down, which will help us as a country to get better ratings from sovereign rating agencies. It will help interest rates to come down in the economy, which is going to crowd in private investments and help growth. Now, what has been the negative for me? So one of the disappointing factors is the lack of any interest in disinvestment of PSUs. So in the last few years, this lack of interest was visible. The only disinvestment we have seen was Air India, which was really, had become an albatross around the government's neck. So they had to get rid of Air India. But other than that, there have been no serious efforts towards disinvestment. In previous budgets, at least there used to be a mention. Now they have even stopped mentioning it. There is no disinvestment target. Disinvestment has been clubbed under miscellaneous capital receipts, which includes other things like land monetization and asset monetization. So they seem to have given up or lost interest in disinvestment, which I don't think is a good thing, because you need to unlock capital which is lying in public sector, and this needs more privatization to support growth and more job creation in the economy. These are my views on the budget. Thank you for the opportunity. I'm open to questions if you want to ask now or later. Thank you.
Yeah, thank you so much, Rudra, for explaining the budget in a very, very lucid manner. And you have explained how the budget has catered to 4 pillars of growth and what will be the implication for industry, particularly for the SME, since most of our foundry sector, they're into SME sector. So I would request, if you have any question, you can ask him. I think after 5, he will have to leave because he has a class. So we can take 1 or 2 questions if there is any. Otherwise, I'll request Mr. Sushil Sharma, our Honorary Treasurer, the Institute of Indian Foundrymen and MD Metachem Private Limited, Shalmix Metalchem Private Limited for sharing the foundry perspective, the budget. What is the implication of budget according to his view for the foundry sector?
Thank you, Abhishekta ma'am. Well, good evening, foundry friends. We just listened to our two speakers, one Mr. Kaushik Mukherjee and Mr. Rudra Sen Sharma. See, budget is always what I should say, a thing which we always try to listen initially, and then unless and until we try to read the fine print, we cannot understand the budget. Because so many times the Honorable Finance Minister tries to put the things in such a way that it becomes difficult to understand for the industry to make out what is good for them and what is bad for them. In this year, the Honorable Finance Minister has announced from the foundry perspective, lifting custom duty for 25 critical minerals and metals, including lithium and cobalt, which are considered the building blocks of the modern technology and also crucial for green energy shift. So this is a good initiative by the Honorable Finance Minister to reduce cost of production of steel and copper. Honorable Finance Minister has reduced basic custom duty on ferronickel and blister copper. For the copper ores and concentrates, currently attracts a basic custom duty of around 2.5%, which has been reduced to 0. While removal of BCD on ferronickel, which is crucial raw material for and which accounts for almost 70% of the total cost, will definitely help the steel industry. As our previous speakers have made statements regarding the government's plan of having a good infrastructure spending with respect to capex of around 11.11 lakh crore. Then another thing, 3 unique commodity specific railway corridors the government has planned to ease congestion on high traffic zones. New airport constructions and orders of new aircrafts, almost around 1,000 numbers. Growing e-vehicle transport systems. So this is definitely going to impact the industry in a positive way. With huge infrastructure spending in variety of projects, it will help not only large-scale industries, but also smaller players, including MSMEs, and across the steel supply chain. As the government has specifically mentioned regarding commodity-specific corridors, which are energy, mineral, and cement, port connectivity, and high traffic density corridors. They have also announced additional 40,000 normal rail bogies will be converted to match the standards of Vande Bharat. This is a very positive news for the foundries who are associated with the railway sector. This will create huge demand for high carbon steel for rails, tracks, forged steel for wheels and axles, structural sections for bridges and tunnels, electrical steel for motors and transformers. So what we look forward is that the foundries which are going to be connected to the railway industry will definitely be having a positive impact. Government also announced mission to boost production recycling of critical minerals, waived off BCD for almost 25 minerals, including antimony, beryllium, bismuth, cadmium, cobalt, graphite, molybdenum, phosphorus, and zirconium. These are few. And definitely by reducing the basic custom duty for all these 25 minerals, which were announced as a critical minerals, particularly for the industrial sectors in 2023, the government has given a positive news to the industry. But government has increased BCD to 150% for lab chemicals. And after opposition by the sector, now they have rolled back to 10%. So initially they increased from 10% to 150%, and again they have rolled it back to 10%. What was the basic aim of increasing for these chemicals, particularly lab chemicals, from 10% to 150% is really, we are not able to understand. And while rolling back, definitely it is a good news for the industry. Overall, in my opinion, budget 24 is a positive and looking forward budget for the foundry, in particular for the foundries connected to railways, water supply infrastructure, and renewable energy. And we look forward to the industrial growth in sector, particularly railways and water infrastructure. And in particular, in my opinion, in general, the foundries at large will be having a positive impact with this budget 24. Thank you from my side.
Thank you so much, sir, for highlighting the major impact budget will have on the foundry sector by creating direct and indirect demand for the foundry. So now we thank all our distinguished panelists for delivering your address and explaining the critical tax issues and other matters. So may I now request our honorary treasurer to deliver the closing remarks.
Thank you, Abhishek ma'am. Well, friends, it was almost 90 minutes for all of us to listen to various speakers on the subject, which is very dear to everybody, in particular when we are into the business. Because we know that in India, the tax structures are being changed by the government every now and then. They introduced GST to come over the service tax and excise duty and lot many other taxes, local taxes, as a single point taxation. But with time, we are finding that GST is getting more and more complicated. But we all look forward to more simplified GST regime, in my opinion, though it is a single tax regime for the industry. And we need to understand the GST more in detail. And I personally feel that the institute will keep on having all such kind of learned speakers in future so that the members are getting benefited. Thank you very much.
Thank you.
Thank you. With this, may we close our session? And I would request all our distinguished speakers to come to our forum again and enrich our members. Thank you so much.
Thank you.
Thank you. Thanks. Thank you.